While this headline may sound like another political shockwave, the implications go much deeper than just international trade. From rising inflation to global market volatility, the consequences could spark a domino effect, and the cryptocurrency market may be one of the biggest beneficiaries. Let's unpack this. The proposed tariffs specifically target core European exports like automobiles, wine, cheese, steel, and luxury fashion. These industries represent some of the EU's biggest economic strengths, and such a drastic tariff would significantly raise the cost of these goods for American consumers and businesses. In response, the European Union is likely to retaliate with tariffs of its own, potentially escalating into a prolonged and damaging trade war between two of the largest economies on the planet. Now, what happens during trade wars? Historically, trade conflicts disrupt global supply chains, reduce corporate profits, create inflationary pressure, and spark fear among investors. Markets become unstable. Risk aversion rises. And when that happens, investors move their capital out of traditional assets like stocks and into what they perceive as safe havens. This is where cryptocurrency comes in. Over the past decade, Bitcoin has gradually gained a reputation as a digital store of value, a kind of digital gold. It's decentralized, finite in supply, and immune to the decisions of central banks or government monetary policies. When traditional financial systems appear shaky, Bitcoin and other major cryptocurrencies often see a surge in demand. We've seen this dynamic before. During the US-China trade war in 2018 and 2019, Bitcoin prices rose alongside market uncertainty. In early 2023, when several US regional banks collapsed, crypto again saw a spike in capital inflow. The pattern is clear. When faith in the global financial system declines, interest in decentralized assets grows. But it's not just about Bitcoin acting as a safe haven. The economic implications of a US-EU trade war could also create structural incentives for broader crypto adoption. Tariffs of this scale can increase the cost of doing business, strain cross-border financial systems, and make international transactions more expensive and less efficient. Crypto offers a frictionless, low-cost alternative to traditional international payment systems. Stablecoins, for example, can be used to move funds globally within minutes, without relying on banks or SWIFT networks. In times of economic conflict, such efficiency becomes more attractive. Moreover, the EU is in the middle of implementing its new markets in crypto assets regulation, also known as MiCA. This regulation introduces licensing requirements for crypto companies, stablecoin rules, and investor protections. While some see this as a crackdown, others believe it provides clarity and a legal framework for the crypto industry to grow within Europe. If Trump's tariffs trigger inflation and financial instability across the Atlantic, ordinary Europeans, especially younger, tech-savvy demographics, may turn to crypto as a hedge or alternative financial system. Even in countries with strong banking traditions, like Germany and France, citizens are increasingly looking at decentralized finance and digital assets as a way to diversify their portfolios and assert more control over their money. And it's not just Europe that would feel the shockwaves. Emerging markets that rely on EU trade, or that are integrated into transatlantic supply chains, could also experience turbulence. In countries with weaker fiat currencies and higher inflation, crypto adoption often rises during periods of economic distress. A US-EU tariff battle could indirectly accelerate crypto usage in these regions as well. Let's also consider investor psychology. Financial markets are driven not just by numbers, but by emotions, fear, greed, and anticipation. If investors begin to see the global economic outlook deteriorate because of protectionist policies, they may begin shifting money into Bitcoin, Ethereum, and other major crypto assets, not because they love crypto, but because they're looking for somewhere to park their capital outside of traditional finance. Influencers and analysts in the crypto space have already begun to speculate on how Trump's proposed tariffs might affect the next market cycle. Many believe that a combination of inflation, currency devaluation, and market volatility could act as a powerful tailwind for the next crypto bull run. Whale wallets are quietly accumulating Bitcoin, and institutional investors are eyeing entry points. At the same time, there's growing distrust in centralized systems. Political polarization in the US, EU disunity on economic matters, and global tensions all add to a sense that the old financial order is fragile. Crypto, for all its flaws, offers an alternative. It's programmable, borderless, and, unlike fiat currencies, not subject to the whims of elected officials or central bankers. That's a powerful narrative in a world where uncertainty is the new normal. We should also acknowledge the other side. Critics argue that crypto is still too volatile to be considered a true safe haven, and that regulatory pressure, especially in the US and EU, could stifle adoption. But history shows that crypto tends to thrive when traditional systems are under stress. And Trump's proposed tariffs could be exactly the kind of trigger that pushes people to rethink how they store, move, and protect their wealth. In the coming weeks and months, all eyes will be on whether these tariffs actually materialize, and how the EU responds. But one thing is clear: we are entering an era of economic unpredictability, and in such times, the role of cryptocurrency is likely to grow. Whether you're a trader, a long-term investor, or simply curious about where the world is heading, pay close attention to how geopolitics and crypto intersect. Because in the age of economic uncertainty, digital assets may no longer be just an alternative, they might become a necessity.